of investing theory. So in today's video, we are going to look at passive versus active investors, efficient market hypothesis, and essential information. But in the past video, we went through the traditional portfolio management, modern portfolio theory, and security analysis. But we can start out by looking at the passive versus active investors. So there's a lot of discussions over whether to invest aggressively or passively, but it's based on the distinction between active and passive investing. Yeah? Hope that made sense. It is recommended to take one of these two approaches when investing, however. Essentially, an active investor conducts analysis and analyzes and follow companies closely. They buy and sell stock based on their potential predictions. Yeah? This investment strategy is common among skilled investors and private investors who have the time to devote to stocks and believe that it is possible to beat the market. However, regardless how the stock market swings, passive investors, on the other hand, purchase a portfolio of stocks or mutual funds and then buy more of them regularly. This approach to investing requires a long-term perspective, so they follow the market. Most of the investments made of students or small investors like ourselves are passive due to limited time. If you have another occupation or work and whatever, yeah. But yeah, so you can either be one or the both. Like it's up to you or it's up to the investors. But there you have the two different strategies of investing. Yeah. So let's go to efficient market hypothesis. Yeah. So as we can see here, efficient market hypothesis shares prices according to EMH, which is the efficient market hypothesis, should reflect all information. On exchanges, stocks should trade at their fair market value. According to efficient market hypothesis, it is impossible to beat the market. However, critics of the EMH believe that the stocks can deviate from their fair value market values, and that is possible, and it is then possible to beat the market. Furthermore, if a share adapts to daily information, in theory, it should have no connection to yesterday's share price, which is referred to as the random walk theory, as we spoke in the previous video. But it is important to keep in mind that the market has no memory. The concept of the efficiency is also based on the idea that no investors should be able to earn higher returns without taking higher risk. So, if a market is efficient, it will eventually settle on fundamental value, and arbitrage opportunity will fade away. This is because more investors are becoming aware of incorrect pricing. There is no complete agreement on market efficiency in context of research, as there are numerous examples of markets failing to assess the fundamental value of shares. Yeah? However, research shows that while the market is efficient in most cases, there is still room for short-term efficiency. The market's efficiency is usually highlighted by the fact that it's overvalued stock or entire markets, especially when the psychological factor is a significant factor, which is a problem in the cash flow valuation because they do not account for behavior, as I spoke on the previous video. Equities should have the correct fundamental value from a long-term perspective. As a result, the share price may be skewed in the short term. Yeah? But for a market to function, it must be rational when gathering new market data. As a result of the first graph, neither the old knowledge can be used to make money. However, when it's said to make money, what it really means is make one risk-adjusted excess return. which makes the whole thing a little more complicated. and continuous. It is therefore insufficient to demonstrate that a trading strategy based on old and new knowledge will gain excess return to demonstrate that the market is insufficient. This return must be a true excess return, and it should be adjusted for the risk taken. It is neither easy nor unconventional to access such risk. But the EMH rules out the possibility of making money through technical or fundamental analysis. The term information is divided into 3 categories. Yeah? And each of which corresponds to 3 different levels of market efficiency. So the term weak market efficient, as you can see on the screen, refers to inability to profit from historical price fluctuations and therefore return on securities. As a result, any plan focused on technological analysis cannot work. While the semi-strong market efficiency states that it is impossible to gain risk-adjusted access returns by using someone who prefers public knowledge. In this way, EMH also eliminates the possibility of engaging in fundamental analysis, and because of the strong market efficiency, insider information would not be possible for someone to profit. Yeah. So let's go over to essential information. So when a new potential investor like you and I are considering starting investing, they must consider their risk preferences, which is a crucial element in investor decision-making behavior. The normal financial theory assumes that investors are rational and their risk expectations are invariant, so they're risk-averse, more or less. When making investment decisions, beginner investors gradually discover that investors' decision-making behavior in real life does not always confirm the assumption on rationality, and that their actions are always limited by their own cognitive biases. Yeah? And the external environment resulting in risk preferences that vary depend on the situation. Furthermore, correlation is also essential for new investors since it is forecasting the future development and risk management in a portfolio by measuring the volatility of a stock. Correlations between assets can now be conveniently measured using a range of software and online sources. Therefore, the correlation shows the association between the variables used and are in a numeric format by correlation coefficient that ranges from -1 to 1, which you should learn on the statistic video on my previous videos, but where there is a perfect positive correlation. The correlation coefficient equals +1. When it is +1, it means that one security goes up or down, the other security stays the course in the same direction. A perfect negative correlation equals -1, which indicates that 2 assets travel in the opposite direction, while 0 correlation indicates that there's no linear relationship. And you should know this from statistics. But that is all I had to say. I just got some feedback on my previous video when you said about the psychological bit. If I just mimic it, so it went something like this. Yeah? And here was 300. Right here, 300. And it went down to 200. And you bought right here. Yeah? So one tip you could do. So imagine this stock has went down and you saw potential, a gap in the market, or you feel like the stock is undervalued or anything. You decide to buy, right? But it continues down. So if you buy at $100, your new price would be, if you bought here and you bought here again, your new price should be here in the middle, which means that if it goes back up, your return would be higher because you bought down your position, right? So if you buy at 200 and then it goes down and you buy at 100, your position decreases. And if this one turns up again, you have higher return. Yeah. And same thing goes if you short. Yeah. So if I have a graph right here, like this, and you're going to short, yeah, let's say it went here, and you short for here example, you first short at $100, it goes up, and it's up here, you short again at $200, your new price should be 150 if you buy the same equal amount. So if you short at 500 here at 100, then 500 again at 200, your price where you bought it should be 150, which means that if it goes down like you calculated, you're going to have a higher return. Yeah. And this has a lot to do with psychology, strategics, and a lot of stuff. But more on that when we use mathematics to help us calculate the risk and expected return, etc. So that was that for this video. I really hope that you enjoy these kinds of videos, because I do. I wish you good health, and I will see you in the next video. Yeah.